Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based insights to help you master the game of building wealth. Okay, let's get into today's Q&A session. And the first listener writes, "Hi Stuart, sending this question on behalf of my friend who wishes to remain anonymous. He recently found out his parents, early 50s, don't have a financial plan for retirement. They migrated to Australia in early 2010s and don't have a good level of English, which has impacted their level of financial knowledge. Both of them are sole traders and don't have any super at all. Their incomes go straight into the mortgage, which is about $140,000 left. Other than that, they have a small amount of savings, around 10 to 15,000 in cash, that they don't have in a high interest account. My friend has only recently become financially literate himself and is very worried about his parents. As someone at a very different stage of life, he feels lost and unsure how to help his parents. He would like to know what are some initial steps he can help his parents take, as well as mid to long-term things they should consider. Thanks in advance." Okay, so the first observation and thing that I've learned is that you can't motivate someone to do something that they don't really care about. So that motivation's really got to come from within. So I guess first thing is that he should explore with his parents whether it's something that's on their radar, whether they're concerned about it or whether they're not. Because if they're not and they're not motivated to learn and take action, chances are it's going to be very difficult to influence their behaviors. But I would guess that, most people want financial security. So I guess that they're probably interested in it, but they just probably don't know when to start. Okay. So that really then starts with education. And so what I would do is start just talking about sort of the basics, and the things where I'd focus my energy on is business structures to save tax, which sounds like a bit of a mouthful, but I'd just be talking about things that, if you're self-employed, there's lots of opportunities to minimize your tax, and that they should be thinking about that. Of course, they don't need to become an expert. They just need to go and see a good accountant. And of course, a shameless plug here that my business partner, Mina, and I produce another podcast called The Holistic Accountant. And we talk about a whole bunch of, things that are sort of tax and investment related. So that sort of podcast is probably a good start in terms of getting some ideas. I'd be talking about the power of borrowing to invest, because obviously, sure, they're in their early 50s, so maybe at the latter end of that sort of accumulation journey typically. But if they've got a very low asset base outside of their family home, which it sounds like they do, and they don't have a huge time horizon, then they kind of really do need to borrow to invest. So I'd talk about the power of leverage, the tax benefits of leverage, and it gives them the ability to invest a whole bunch of money, particularly if they've been aggressively repaying their home loan. They've probably got a bit of equity in their home. And, if they see a good accountant that can put their financial situation together that not only minimizes tax, but also they need to maximize their borrowing capacity, that could be really effective. And then I'd talk about the tax effectiveness of super and super contributions. So again, particularly for people in their 50s, if they're self-employed, they don't have to contribute to super. They can certainly avoid doing so, but there's obviously some tax effectiveness there. So I would try and keep it super simple. Don't overcomplicate it. All you really want to do is not talk about the fundamentals necessarily or the detail. Talk about the outcomes, like saving tax, building equity in property outside of the family home, these sorts of things, so that they can kind of connect with, the end result rather than what they need to do to get that far. Once you kind of germinate the interest, I think, and if there is interest, I think what they need to do then is, educate themselves. Again, they don't have to become experts, but just broad-based idea of, property versus shares, gearing into property. How does property work? What is investment grade property? All the sort of stuff I talk about in this podcast. And if they have just a general broad idea, then it's just about choosing the right advisors, I think. And it starts with a really good accountant for them to obviously structure themselves. And then hopefully if they find the right person that's able to guide them and make some decisions, that might be the best way to do it. So I think that's the thing, is just start talking about it at home, start sharing sort of information, try and germinate that interest, and then, start feeding them maybe some podcasts or articles or these sorts of things. And then once they're off and running in terms of really interested, then I think it's just about helping them find the right advisors. But hopefully that gives you a little bit of food for thought in that one. Okay, next question is from Mark. Mark writes, "A great series on the different superannuation options. Mark's referring to episodes 325 and 326, where I talked about the different super options in terms of retail funds, industry funds, wrap platforms, and self-managed super funds. So you can go back and have a listen to that one if you like. Anyway, Mark continues on to say the pooled CGT thing is very opaque to me, and I've been trying to work out what the difference would be versus a pooled option versus a self-managed super fund. And so just a little bit of a side note here, what Mark is referring to is if you have a wrap platform or a self-managed super fund, so not a unitized or pooled product like a industry fund, that when you convert to pension phase, any unrealized capital gains disappear. You never pay the capital gains tax. Whereas with a pooled and unitized product, tax is subtracted in the unit price each day. So you essentially get paying capital gains tax each day, even though you haven't made any changes to your balance. Okay, so Mark continues to write, CGT and super is 15%, I believe. No, it is if you own the asset for less than 12 months. If you own the asset for 12 months, CGT inside super is actually 10%. Anyway, Mark continues, we're in our mid-40s and just hit $680,000 between us in Q Super going into a low-cost index option, 40% in Australian and 60% in international shares. I looked at the different options on 640,000 using DHHF or VDHG, which are diversified ETF options. And he goes to sort of compare the costs, if you had a wrap platform with net wealth and so forth. And he said, there's not much in it, but and he's sort of just to paraphrase, if you like, sort of asking, what potential saving could there be? So I did some numbers for you, Mark, and I should say, when I mentioned the difference between, capital gains tax and so forth, how these different products behaved, I did consider whether I should put an example in there in terms of calculating the impact. But there are actually a lot of moving parts to this in terms of how is it invested, what platform we're using, what structure, how much turnover is there in the portfolio in terms of rebalancing these sorts of things. So, and then how long, what's the starting balance and how long until retirement. So there's so many moving parts. I actually decided I didn't want to do it because I didn't want to necessarily misrepresent whether there's going to be a huge difference or just a small difference, because it's going to depend on so many different factors. Okay, so anyway, I'm Denard. So anyway, I had a look back to do some numbers for Mark in his situation where he's got $680,000 and he's in his mid-40s. So let's say 15 years away from accessing super. So I had a look at the Vanguard products. I had to look at the managed funds, not ETFs, because they've been around since 1997. So a pretty long, significant amount of data. And so if you put 40% in Aussie and 60% international, since 1997, you would have received 3.5% income and 4.4% in capital growth. So then if I assume that Mark and his spouse contribute, say, $40,000 a year in total, I worked out that avoiding the capital gains tax over the next 15 years would result in a balance that is 7.9% higher, or about $250,000, which is $180,000 in today's dollars. Now, if he was very dependent, of course, these savings are very dependent on how much growth you get. But if actually he was able to achieve a higher growth rate, instead of 4.4, it's 5.5, the balance difference is higher, it's 9.8, let's call it 10%, or $250,000 in today's dollars. So quite compelling. But it really depends. I mean, if the growth is really low, of course, there's not much saving. Now, you could use Vanguard Super to do that. Now, Vanguard Super would charge you $840 plus 0.28%, which includes an admin fee and an investment fee, which I didn't read out the details, but broadly in line with what Mark is currently paying at Q Super. So essentially, you could find a place to do this if that's the strategy you wanted to do it in, that's not going to give rise to much fees and would then potentially provide some capital gains tax savings. Now, I must say that I have not yet confirmed directly with Vanguard that their product works exactly like this. So please don't take this as advice. As I said in previous episodes, in July, August, every year I complete an analysis of the top 8 industry super funds. This year I'm going to include Vanguard Super. I'd just like to wait a little bit more time to see, how it all works, and we'll sort of work through that ourselves. We've just become registered with them, and we've used Vanguard for a long time, but Vanguard's super product. So we're going to delve into that a bit more over the next 6 months. And so please don't take this as advice, but if you're a regular listener to this podcast and I start thinking that Vanguard Super is the way to go, because I would say at least at this stage, and again, I haven't completed the analysis, but at this stage, it's looking like a really good alternative to the industry super funds. But as said, please hold fire, don't make any changes. Now, the one thing I would say here is I would invite you to think about whether that's actually a good approach, right? If I put 40% in Aussie and 60% in international, firstly, I don't have any defensive investment. Now, I don't think that's a downside. In fact, I've done a podcast episode about, well, maybe we should be all equities anyway, because in the long run, that's going to deliver the highest return. And that's fine for Mark, because if he's 15 years away from retirement, that's completely fine. But if you're 5 years away from retirement, that might not be appropriate for everyone. So that's the first observation about, putting 40 and 60 into those markets. The other observation would be the 60% international. We've got to realize that 70% of that portion of the international portion goes into the US market. According to the S&P 500 index, that market's pretty heavily valued and has had a tremendous run over the last 10 to 12 years in terms of returns. It's been double-digit returns, I think around 12, 13% or something like that, compounding over that time. It means that there's a high probability of a bit of mean reversion there, which means if we're going to go all traditional cap indexing into international markets at a time when we're probably likely to see some mean reversion that affects 70% of that exposure, then I think it would be reasonable to assume that the returns that we'll get from international market cap indexing over the next 10 years are likely to be below average, below the long-term average. And this is what I sort of try and talk about a little bit in the podcast is, well, that's fine, but use a bunch of different indexing strategies, value overlay, factor approach, dimensional indexing, these sorts of ones that I've spoken about actually in episode 313, where I talked about alternative indexing strategies. So you can go back and have a look at that. So look, it's difficult, right? People think, well, I'm going to take this approach to minimize capital gains tax, or I'm going to take this approach to minimize fees. But actually what you want to do is take a holistic approach that balances out minimizing fees, maximizing returns, and minimizing tax, which ultimately all go to maximizing the end balance. And not one of those attributes is necessarily more important than the others. They all need to be considered. So it's a great forum to provide these answers because we've got some context with Mark's question. But Mark, hopefully that answers your question. I guess the answer to your question, how can you get, if you're going to take that approach to investing your super, and let's, as I said, put aside whether that's a good approach, it looks like that you can do that in a really cost-effective way with Vanguard. And it looks like that the tax that you might save might be somewhere between 8 to 10% of your balance, like in terms of your balance will be 8 to 10% higher by the time you get to 60, based on my calculations. And but don't take any action. Let's see what we come up with mid-next year in terms of that super review. Okay, and the next question is somewhat related to that one. It's from Indran, and Indran asks about the Choice Plus option within Host Plus Industry Super Fund, which allows people to invest 80% of their balance in direct shares or ETFs, and the other 20% needs to be in a pre-mixed option. And he's suggesting that it looks like a low-cost option that also helps avoid capital gains tax. And he's wondering what I'm thinking about that, or what I think about that, I should say. Okay, so I answered a similar question back in December, and I actually suggested I put it on my blog list. I might write a blog about it and do a podcast episode about it. No promises if I get to it, but I mentioned back in December it had some merit, and it certainly helps minimize capital gains tax in the same way that I just answered Mark's question. It has a small investment menu. So I guess going back to my previous comments about, market cap indexing, the US market, what future returns might look like, you don't have a huge investment menu to be able to sort of necessarily accommodate that investment risk. But as a broader view, I just wonder whether people should be managing their own super asset allocation. You could either go really too simplistic, again, going back to my answer to Mark, the previous question from Mark about a 60-40 split, whether that's going to be good, particularly if you've got a significant balance like Mark and his wife or his partner have 680,000, and that's going to compound significantly. So, just a small difference in percentage returns will make a big difference to the balance in the long run. Also, people tend to make financial decisions based on emotion, whether that's being too greedy sometimes, being too conservative sometimes, being irrational and selling down and exiting a market. There's a whole bunch of reasons why I don't think most people, most Australians, should be managing their own super asset allocation. And the answer is, sometimes the answer is, I enjoy it. That's not a good enough answer. I enjoy lots of things, but I shouldn't be doing them all the time. Like, I built a deck once and I really enjoyed it, and it turned out okay and it was fine. But I'm not a builder, right? Leave that leave that stuff to the experts. So, just because you enjoy it isn't a good enough reason. In fact, I would say that could be bad news, because you might be touching it too much or overthinking it. Anyway, so it's got some options there, or some benefits. The cynic in me says that the only reason it exists is to convince people not to start their own self-managed super fund, because that's the goal of industry super, is to never let you take your money away and put it onto a different platform or ownership structure. But anyway, it is what it is. I'm just a bit cautious of it. Okay, next question is from Kim. Kim says, I'm thinking about moving my super, which is 550,000, from Host Plus index balanced to Fisher Investments, who uses the NetWealth platform. So this is my basic understanding of Fisher Investments. They charge 1.68% for a balance over $1 million. That's $16,000 on $1 million balance. I don't know about you, but I'm not going to ever pay someone $17,000, almost $17,000, to manage $1 million worth of investments. Anyway, Kim says I can probably make the $1 million cutoff with if I combine my partner's super. So Fisher manages the account. They say that they average a 14.5% return recently. They only invest in ASX 200 shares, a small amount of international, some emerging markets, so no private equity or alternative assets. My understanding is Fisher just buys the shares in my NetWealth account on my behalf, and that's what I'll be paying for. So my motivation of getting away from generic accounts like Host Plus, because my balance is higher and I'm now 55, so I need to migrate from accumulation to pension in about 8 to 10 years, looking for about 1.6 million by then. I have a property investment outside super in my own name, so in time I will sell the house and pay out the debt on others and put the balance into super when capital gains tax can be minimised. Hope it all makes sense. Questions are, what do you think of Fisher Investments? Okay, so just for other listeners, what Fisher Investments are doing is what's called an MDA, Managed Discretionary Account, which means that you give me the money as an advisor, it goes into an account in your name, and I can then trade and do whatever I want to do within a specific investment mandate. So, Fisher might decide across all their clients, let's sell BHP and buy CBA, or the reverse probably in this market. They can execute those trades, and they don't necessarily have to report to you or get any authorization, which is fine, because that's what a fund manager does anyway. I mean, they don't report to you every day and tell you what they're doing, but that's how it sort of works. So it's all quarantined in one account. I guess there's a few red flags here. 1.68% fee. No way would I ever pay that. I'm going to get to why in a second. I'll give you the evidence, but that's a ridiculous fee. Small amount of international exposure. Well, I would say, hang on. The Australian market is about 2% of global developed markets. So you're missing out on 98% of everything else going on in the world. Australia doesn't have very much technology exposure, for instance, and it's got too much concentration in mining and financials, so the banks and the big miners, and so you don't have a lot of diversification. It's actually, I would argue, and it's going to kind of contradict what I'm about to tell you in terms of stats, but I would say that it's kind of easier to outperform the Australian market as opposed to outperform the US market. And the reason for that, the US market is so much bigger. There's so much more diversification. Returns can come from lots of different directions. In Australia, if the banks have a good year, the index has a good year. But conversely, if the banks don't have a good year, the index won't be that hard to beat. Similarly for the miners as well. And because we've got that so much concentration, and if the banks have a bad year, you'll look like a good manager by comparison. So anyway, the first thing is, so no international exposure really worries me. Well, if you're running MDA where you're trading shares, direct shares, it's just too hard to do that across international markets. So it's a consequence of their approach, but they're trying to sell a story of why you should pay them 1.7%, and I'm just not buying that story. 14.5% return, that's great, but I'm going to come back to that in a second. Well, actually, let's talk about it now. So let's look at the evidence. And Fisher, their approach, and MDA is a active approach. What they're actively trying to do is buy and sell shares to outperform the index. So let's have a look at how active managers have performed over the last 10 years. And according to the SPIVA report, which is global research put together by S&P Dow Jones, and you can find that online. It's SPIVA, S-P-I-V-A. Just Google that, you'll find the SPIVA report. And it shows that 82% of active fund managers failed to beat the index over the last 10 years. And that's not to say that 18% beat the index over the last 10 years, because it's a different set of fund managers that make up that 18%. So let's then delve into it. And we don't have 2024 data because as I'm recording this, that data isn't published yet. So if we go back to 23 data, what we can then do is have a look at, okay, who was in the top quartile in 21, and then the persistence of that throughout. So let me explain. So in 2021, that calendar year, so by the end of that year, December 2021, there were 329 active fund managers in Australia. Out of that 329, in that 21 year, 196 beat the index. So about 60%. It's pretty good rate, right? Of that 196, in 22, so this is 2 years running, 158 beat the index. So about 50% beat the index 2 years running. That's really good too, right? It's not really good. It's a 50-50 bet, but it's not bad. Here's the kicker. By year 3, so 2023, only 7 of those original 196 active fund managers were still in the top quartile in terms of performance. And top quartile is probably going to beat the index. So really, that's less than 2% of the original ones that beat the index back in 2021. So you can see the picture I'm painting here is, and this is just an evidence-based approach. It means if you're going to invest in an active fund manager, that's fine. They've got maybe a 50-50 chance of beating the index over the next 12 months and the next 2 years in a row. But the chance of them doing it 3 years in a row is very remote. So what you're going to have to do is invest with Fisher, hope that their performance stays at 14.5% that they've advertised. But at some point in the next 2 years, you're going to have to move. And if the whole point of going there is to save capital gains tax and minimize turnover, that's going to be contrary to that. Also, if they're buying and selling shares, they're going to crystallize capital gains tax along the way. There's not going to be a lot of unrealized gains in 6 to 8 years, as you hope, with that sort of approach, because it is a higher turnover. And that's a question you should ask them, in fact, what is the turnover? Because not only are you going to pay 1.7% in fees, you're going to pay a lot in tax as well. This whole podcast, Investopoly podcast, espouses the benefit. What I'm trying to do is actually communicate the benefit of following a evidence-based approach. And there's no evidence to suggest that this Fisher approach or a MDA, managed discretionary account, is the right way to go. It's expensive, it's high turnover, the probability of you being better off is low, the probability of Fisher Investments being better off is very high. Okay, Kim's second question is, given the fees would be really high, nearly $17,000 a year for $1 million, would I be better off getting a financial advisor? I'm not going to answer question 2 because I'm going to go straight to question 3. Because Kim writes, in the coming years, I will receive a rather large inheritance, which I've been instructed to get to the next generation. So I would need help at that time. Maybe I should wait until getting a financial planner to deal with the whole lot. Look, I don't know the size of the really large inheritance, Kim, but I suspect that my answer would be, well, my answer is definitely don't go with Fisher. That's clear. And my answer is probably, if you've got $1 million of super, it's kind of borderline whether it's worthwhile paying for financial advice. But if you then throw the inheritance into the mix, it's probably almost certainly better off for you to get financial advice at that time. And also, if what you're trying to do is create intergenerational wealth and just be the sort of custodian, if you like, of that inheritance, then I would argue it's quite important that it's really well invested using hopefully an evidence-based approach, which I talk about in this podcast. Thanks for your question, Kim. It's a really good one. Okay, next one is from Matt. Matt has a question regarding asset protection. Really good question, by the way. Matt writes, I have a business, a company, which I'm a 50% shareholder of. The business has been going for about 8 years and it's starting to generate some decent profit, about $500,000 a year, and has net assets and goodwill of about $2 million. When I started the business, me and my partner were only 24 years old and single, but we've both found romantic partners in recent years. Neither of us are married, and both of us intend to stay with our partners for the long term. But I was alerted to the fact recently that if one of us were to experience a relationship breakdown, there's a risk of 25% of the business assets being at risk. What is best practice in this type of business structure when wanting not only to protect your interests from a marriage breakdown, but also protect the potential relationship breakdown of diluting control of my business? I've been recommended to think about a BFA for both the 50% owners. Would appreciate your thoughts. Matt, it's a really good question, and well done on you for thinking about it, because statistically, it's probably most people's highest asset protection risk, as opposed from being sued by a creditor or something like that, is a relationship breakdown. Certainly a binding financial agreement, BFA, prenup, postnup, whatever you want to call it. I mean, if you're interested in protecting your assets, that's something you should absolutely do. The sooner you do that, the better off. Typically, you're better off to do that before you cohabitate together or before you combine finances, which is not to say it's too late if you've already done those things, but typically it's better to do that before you move in together, as I said, or combine finances. And in that, you can stipulate, for example, that each of you, should the relationship break down, that each of you at least walk away with what you came into the relationship with, which would be your shareholding, of course, and then split the difference, if you like, in terms of the wealth that's accumulated since. In a BFA, you can specifically exclude assets from a relationship breakdown, and both of you can agree to do that. So that would certainly be one way to deal with it. I'd also say you should every sort of business partnership, whether it's a company or unit trust or whatever the structure of the actual business, should have a shareholders agreement or unit holders agreement that would stipulate lots of things about what you do if there's a disagreement between yourselves, or if one party wants to exit, or these sorts of things. But a shareholders agreement can then contemplate the situation where you go through marital separation, and the assets are dealt with. The family court, can make wide-reaching determinations and instructions. It's likely they're likely to say sell the shares rather than transfer the shares, but they could say, okay, transfer the shares in equal parts to both spouses. One thing you could put in that shareholders agreement is to say that is to record that your intention is to be business partners, and that you wouldn't be interested in having non-working business partners. And if one of the business partners became a non-working business partner, that they would have to relinquish their shares or sell their shares back to the other partner. And having that in a shareholders agreement, I mean, the court could overrule it, of course, but that it's less likely, I think, that the court would overrule something like that, and would just make it really clear that these two people in business, and the person that's working in the business also has to be the shareholder. So therefore, your spouse, if they're not involved in the business, really can't be a shareholder. But a BFA and a shareholders agreement should get you a long way to giving you some asset protection. And good on you for thinking about those things. And just speak to your accountant, I guess. If you've got a good accountant, they should be able to point you in the right direction of the people that you should be speaking to about this, and also maybe give you a little bit of advice. Okay, next question is from a pen. I hope I'm not great with pronouncing names, so let me apologize. Let me give you a blanket apology right now for this episode and future ones. Okay, they write, I'm sure this is an all-time favourite topic of whether should we invest in stocks or property. I've been investing in shares on the ASX and my return is above 20% per annum. Wow, that's a good return. But I have to pay a lot of tax in addition to my salary income. What's your view on saving tax? And do you think property investment would create more wealth given it's just over 5% yield due to tax benefits? What's my view on saving tax? I've got a pretty strong view on saving tax. I kind of enjoy it. I don't think any of us enjoy paying more tax than we need to. So I've answered this in a couple of other ways, in a couple of other questions around the tax effectiveness of an investment strategy. Really important, right? So if you're doing some share trading, that's great. If you're earning 20% returns, that's awesome. If you're paying half of that in tax, that is not so awesome. And so that's really the power of compounding returns, is that you don't pay tax along the way. If you're going to pay tax every year, that really diminishes returns. It has a significant impact on diminishing returns, and is not a good long-term strategy. Whereas if you've got compounding capital growth over very long periods of time, of course, you're not paying that tax every year. You'll pay it eventually when you sell the asset, but you're not paying it every year. And that is the true power of building wealth, because the compounding really kicks in after many decades. So, but I would refer you back to episode on Christmas Day, the 25th of December, that Campbell did, where he talked about, the benefit of gearing into property versus ungeared into shares. And my view would be, use an investment strategy in the share market that minimizes turnover and maximizes compounding capital growth. That's a good idea. Or invest in property and do the same sort of thing, minimize yield, minimize income, which maximizes your negative gearing benefits, but just maximize that compounding capital growth. If you want to build wealth, so if you're young and your asset base is low, the key thing you want to do is build your asset base first. The easiest way to build your asset base is compounding capital growth. The most effective asset to give you compounding capital growth is a low-income, high-growth property, so an investment-grade property. That's not my opinion. That is just simple maths. That you can prove it using simple maths. That is going to be, in the long run, the most simple and effective way of achieving that outcome. Okay, hope that answers your question. Last question from Giles, because it's just a quick one. Giles writes, I've split my home loan now. Approximately half is used to buy income-producing assets, and I imagine the other half is for his home loan. If I find a better deal in another bank, can I refinance but keep the splits and the structure? Yeah, absolutely. If it's what's called a dollar-for-dollar refinance, which means that the lender repays a particular loan out and then refinances, you're retaining the tax nature of that debt. So as long as and you can increase the balance, but then you've got to be really careful about what you use the additional funds for. And so I'll give you an example. If your split is a $200,000 home loan, $100,000 for income producing assets, you might then say, look, I really want to borrow more to invest more. And so I might say, let's go and refinance your home loan. We're going to set up a new loan for $200,000. We're going to use that just to refinance the home loan. And then we're going to get a new loan for $300,000. And we're going to use that to pay out the existing $100,000 loan. And then we've got an extra $200,000 to invest. In that situation, what we would do is we'd set up those new loans of 200 plus 300 at the new lender. When the refinance goes through, because all these loans are what's called fully drawn advances, which means they have to be drawn when the loan is set up, what will happen is the home loan will just be refinanced. It's 200 for 200. It's a perfect replication on the other side. For the new $300,000 investment loan, what will happen is they'll pay the existing bank the $100,000, repay them, and then they'll put $200,000 in an offset account or a bank account. That would be your surplus funds. What you should do then is take that $200,000 and repay it into that $300,000 loan. So what you're doing is reducing the balance of that loan from $300,000 to $100,000. But as long as the loan is set up correctly, you'll have access to those monies via redraw. So then when it comes time to make investments, and hopefully what you would do in that situation if you're investing in the share market is periodically invest on a monthly basis, for example, like I've spoken about in the podcast many times. And in that situation, what you would do is redraw, let's say $10,000 a month out of that loan, and then the next day invest it in the market. And that way it creates a nice clean audit trail of, okay, this original loan was the original balance was $100,000, and that was used to refinance the previous loan, which was tax deductible. And now you can see these $10,000 transactions each month, and you can then see the next day I invested that money in shares. And so there's a clear audit trail to demonstrate that those loan funds were used for income producing purposes. So that's how I would set that up, and that's how I would implement that. Really important thing, right, by the way, because for investors, their biggest tax deduction is interest, and you never want to compromise that. Okay, run out of time today, a little bit longer. I'm trying to get through a lot of these questions that I keep saying. If you have any more questions or feedback, please send them to me at questions@investopoly.com.au. Campbell will be back with you tomorrow for his final episode. I'm sure I'll get him to jump in and do some more episodes this year. So if you've enjoyed Campbell's episodes, would love to even receive that feedback. And for me, I'll speak to you again next week. Cheers.